Abby, very good to see you. We have a timely topic, how to invest when interest rates are cut. Interest rates have been high since March of 2022, but they are finally coming down. That means it's time to rethink how we are investing. But before we get started, why is the Fed now lowering rates?
Right, Aaron. So we've been in this environment where interest rates have gone up and they've gone up really quickly. So the Fed has finally seen numbers that they're happy with as far as inflation, economic numbers. So they decided that it was time to go ahead and start cutting those rates. And this is just the first of what we believe will be many rate cuts in the next 6 to 12 months, especially. And this is what they're trying to navigate, keeping inflation under control, but also keeping unemployment at target levels. So that's really their dual mandate that they have. So they're going to try and balance that to keep the economy stimulated. So they don't want to depress it too much, but also continue to keep inflation under control. So that's what they're trying to do. It's a delicate balance there.
Right. I'm glad you brought that up because, of course, the risk of raising rates is that it pushes the economy into a recession. So, when will we know that we have avoided a recession?
Yeah, so this has been talked about for years now
Yeah.
about when is the recession going to happen? Has it already happened? And this is a very different cycle than we've really ever seen before because of the pandemic and the behavior of interest rates because of the pandemic, the economy because of the pandemic. So it's been very, very unique. But basically, what we're looking at right now is continuing to look at obviously inflation. So hopefully that continues to go down and moderate, but also really keeping an eye on unemployment and hopefully making sure that doesn't continue to tick up. So there needs to be at least a certain amount of unemployment, which sounds really odd to most people. But if unemployment is too low, if the job market is too strong, that really drives inflation. So that's what they're going to be keeping an eye on. That's what we're going to be keeping an eye on. And if that starts to tick up too much, then that can be a potential recession indicator. A lot of the tried and true recession indicators that the finance industry has used for decades have not been
Yeah.
accurate in
Right.
this cycle. So we're looking at things in a different way because of, like I said before, because of the pandemic and because
Mhm.
of the unique cycle we're in right now.
Mhm. So now let's talk about investing when interest rates are on the decline. What is the biggest difference?
So the biggest difference here is easy money, I would say. So when I talk about easy money, I'm talking about things that are completely liquid, accessible, they're safe, so you don't have to take any risk to get that pretty good rate of return. So high yield savings accounts, CDs, even bank accounts, money markets to a certain extent. So you could just park your money there and get over 5%
Yeah.
for the last couple of years, which a lot of people were very, very happy with. So that is going to definitely change. I actually just got an email from one of the companies that I have a high yield savings account with, and they're saying, hey, we're reducing rates. That's the second one I've gotten in the
Yeah.
last couple of months, and that's going to continue. So really what we need to keep an eye on is our lazy money, as we like to call it. So anything that is earning under what typical inflation is, that's going to continue to earn a lower rate. So we need to be mindful about where that money is.
Mhm. All right, so now we'd like to talk through some specific investments to consider now that rates are coming down. And the first one on your list, Abby, small to mid cap stocks.
So large cap stocks have outperformed for especially the last couple of years. And when I say large cap stocks, I mean big companies, like huge companies. They have really benefited from the very low interest rate environment that we were in. And then also really benefited from the rapidly rising interest rates. So they have been really the clear leader over the last couple of years, especially. As we start to see those rates go back down, this is when small and mid cap companies, so small, medium sized companies, can really start to edge ahead, especially because we can now buy them cheaper. They have lagged behind large cap stocks. So this is a clear opportunity that we think is going to emerge in the next year or so that gives us an opportunity to take advantage of those potentially outperforming even the large cap stocks, the Magnificent Seven, those that have been
Mm.
out of returns out of the park. So
Right.
this could be potentially a reversion of that trend.
High yield investments.
So these are going to become more popular as interest rates are lower. And what I want to remind people is to be mindful and be careful of these. So if you're looking at a bond, potentially a high yield bond or a high yield, even a dividend stock, there might be a reason that there's a higher yield on those than maybe some other ones. So are they riskier companies? Are they lower rated bonds? So there are some high yield opportunities that have a good risk return profile, but it's just being careful of those. People can start to get into trouble when there are much lower interest rates on safer investments. They go and look for higher yield somewhere else, and it's important to be careful about that, because there's usually a reason there's a higher yield on those, and sometimes it's okay and it's appropriate for your portfolio, and sometimes it's just not worth the risk of that higher yield.
Right. All right. You said bond a couple times. Bond ETFs.
Yes. So bonds, I've heard from a lot of clients not being very happy with bonds over the last, 5 years or so. And that has started to shift a little bit. So the risk return profile for bonds, especially bond funds like ETFs, has become more favorable. So in a higher interest rate environment, that yield from most bonds are going to be higher. So that income that it kicks off can be higher. Also, when interest rates start to fall, the capital appreciation goes up for existing bonds. So there's kind of two benefits to the interest rate environment. Bond ETS is a good way to basket a bunch of bonds together, so you're not taking on too much risk in any one bond, and you're also diversifying over maturity lengths too, which have a direct impact on the impact that the interest rate environment has on them.
And next we have REITs, real estate investment trusts.
Yes. So real estate investment trust is a way to invest in real estate, commercial real estate, all kinds of real estate that otherwise you wouldn't be able to, as a individual investor, have access to. These are millions of dollars. These are big apartment complexes, big office complexes, that sort of thing. And as interest rates go down, there's going to be most likely some more investment in the real estate sector. So borrowing costs go down. That can increase the inflows into that sort of sector. And real estate investment trust is a way that you can take advantage of that without having to go out and be a landlord. And also they kick off income, so they can kick off some consistent income. So you can have both of those things going for you.
Probably related then. The next one is housing stocks.
Yes. So this is one that's a little bit more specific, but it is something that could benefit from decreasing borrowing costs. So mortgage rates are going to go down. Most likely there's going to be an increase in building. I don't know about where everybody else is, but around my area where I live, there are apartment complexes going up like crazy. There are houses going up like crazy. And I believe that's going to continue. So anything that could be boosted by housing demand. So anything that's in any companies involved in home building, real estate investment, real estate development, home improvement services, construction, those type companies could potentially have a big benefit from the current environment that we're in.
Interesting. All right, a lot to consider here. Abby, if somebody would like to make sure that they are well positioned, what's the best way to reach you?
You can always give us a call at 678-442-0255. I also recommend visiting our website at theretirementfamily.com. We have a lot of great resources there. You can also send us a message. Let us know what's on your mind. We can set up a 15-minute call with one of our fiduciary advisors.
Great. Abby, thank you.
Thanks, Erin.